Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, and I have a very surprise and special guest. We have another creator of content from John Burns Real Estate Consulting. If you follow my daily financial news, I reference their data all the time because it is amazing. So let's welcome Eric Finnegan to the show. How you doing, Eric?
I'm doing well. Good morning, Michael. Glad to be here. Can't wait to dive into the conversation.
Rick has been on the channel a couple of times. He goes, "Hey, you got to talk to my boy Eric." I'm like, "Let's do it." So thank you very much for accepting this invitation.
Yeah, you're welcome. Again, excited to dive in here.
So do the audience a favor. It's the first time on the channel, so talk about your experience in real estate, what you do at John Burns, where you at, all of that kind of blocking and tackling, and then we'll get into the meat of the conversation.
Sure. So this morning we are talking in my home office. I'm in Boulder, Colorado. I've been focused on the housing market, doing analysis and forecasting since about 2007. I remember my first day on the job in 2007. The Fed announced some emergency liquidity measures, and I had asked my boss, like, what's going on here? And no one really knew. And so the next really, it's been, I guess, 15 years now. It's been a huge learning experience, huge learning curve, and endless learning opportunities. And it's just how I stay really focused, is learning as much as I can about housing, the economy, everything like that. So at John Burns, I joined about a year ago, and I cover a few different aspects of the housing market at John Burns. We have a huge team, a lot of specialists. I sit in a unique position where I'm specialized in building products research, specifically professional remodelers and professional remodeling. I also co-lead our firm's demographics research with my colleague, Chris Porter, who literally wrote the book on housing and demographics. Also, I present to audiences on general housing and the economy. So a mix of a specialist and a generalist here, and I'm excited to see where this conversation goes. I'm hoping I can contribute and add value here for your listeners.
There's no question. So just kind of lay the land, folks. If you want, we're going to talk about general. It just makes sense, I think, to talk about the economy generally. Then we'll talk about housing generally. Then we'll talk about remodeling, and we're going to end on demographics, kind of given your experience. All of those are important, and I think that would put a nice bow on this conversation. So, Eric, general economy, 2 quarters of negative GDP growth. I think general forecast is for Q3 to be slightly positive. We're talking 1.8 something, generally speaking. Are we in a recession? Are we not? Is a technical definition, a rule of thumb. I think it's fair to say, no matter where you come down on that debate, we are below trend. I think that's fair. We just had a Fed meeting last week where they came out, they out-hawked the hawks, right? Higher, faster, longer. And the dollar's going bananas. It's going to have impacts somewhere, including earnings and general economy. So when you look at the economy, what do you see through your experience and your lens? Because it's wild. I've been looking at it for 30 years, and it's got a lot of pieces flying all over the place.
Yeah, I think it's a really unique kind of situation now where if we're at the precipice of a recession, or if we are in a recession, it doesn't look or feel like a typical recession. So the General Recession Dating Committee inside the government, the NBER, they identify, I think, 5 or 6 economic indicators that they look quarterly and monthly to identify, are we in a recession? And none of them are saying we're in a recession right now, except if you look at GDP. So GDP, yes, quarter negative the last 2 quarters, barely positive tracking this quarter. And again, given the strength of the job market, it just doesn't look or feel like a recession. So I think it's one of those sort of through the looking glass things, or Rorschach test. You can look at sectors of the economy, and some look very strong, some look very weak. I sit and look at housing every day. So housing looks very, well, I should say most of housing looks very weak, but there's actually parts of the housing market that still look very strong. In particular, remodeling, which we'll get to later. Yeah. So it's a really, again, Rorschach test, very wide spectrum. I'd say the range of outcomes over the next year, if we're looking at what could job growth be over the next year, my confidence interval, so what I'd be confident forecasting, is very wide. So it's a wide range of possible outcomes at the moment. We could go through a technical recession, official dated by the NBER, with little to no job losses. That's a possibility, which is strange to say.
Yeah.
Which
Yeah,
has big impacts on real estate too.
Oh, absolutely. We're going to get to the housing market next, but kind of on the general economy. The rule of thumb is just that. So I have an econ degree, been studying this for a long time, right? The rule of thumb has worked for the last 10 recessions. Last time it didn't was 1948. I think it was Q2, Q3 from memory, if memory serves, right? And then because the average person doesn't understand the intricacies of the economy, hence this easy rule of thumb, right? But from memory, it's retail sales, producer, whatever their, producers are making, employment, and I forget what the other one is, something else, maybe imports. But yeah, the general metrics that the 14 people or whoever that board is, they're not going to call Q1 and Q2 recession. Of all the metrics, only like a couple of them were red. There's no chance they're going to call Q1 and Q2 a recession, my opinion. And it will only be in history. They won't even call it for another 6 months. Right. So let's move on from the economy. Let's go to housing. I think it's very clear. And Jerome Powell has addressed housing twice in the Q&A session. I think the first time in June, he said the dreaded housing reset, which of course set the Twitter world. Oh my God, the great reset. This evil organization is going to come tear up the world. No, I don't think that's what he meant at all. But more importantly, he defined what he meant by reset this last time. And basically my takeaway was we can't have, supply and demand be so out of line. We can't have a general trend of 100K over asking be the normal, right? We just had a bunch of people feeding on this. My stance is the Fed has created this. You'll see me most often quote, the Fed broke housing, because I think they broke it for years to come. Interest rate lock-in. So we're going to see supply destruction like we haven't seen since the 80s. But again, we have a Fed, Powell, focused on housing. We're the most leveraged business. We're already seeing housing transactions crash. So when you look at the housing market today, it's generally speaking, outside of remodeling, which we will get to next, the housing market doesn't look great. What do you think?
Agreed. There's multiple sectors of housing right now that are crashing, correcting, whatever word you want to call it. You look at starts and permits. So this is the leading edge of supply. Those have fallen by 25-30% since February. Yeah. And we're already going into this with what we're calling a shortage, undersupply.
Me too.
So based on where vacancy rates have been over a long period of time, the vacancy rate is just absurdly low at the moment.
It's a deviation or two away from normal. It's not like a 1 point thing. We're talking standard deviations stretch. Right. So yeah, agreed.
Right. So we're going into this in this bit of a different, if you're comparing this to 2007, there's a lot of differences between the housing market correction today versus what it was doing 15 years ago. Housing, new transactions, new home sales, existing home sales falling off. The more, just go back and wonder who forecasted a doubling of mortgage rates over the year. Who forecasted mortgage rates hitting 7% at some point during the year? I personally didn't. Our firm didn't. No one in we generally forecast the mortgage rates based on what the bond market's telling us, and that the bond market's just been wrong. Pretty obnoxiously. So it's hard to underestimate or hard to overestimate. That's the word. The impact on the mortgage rate correction and the volatility. We have a mortgage rate sensitivity model that I update on Twitter occasionally. It just goes viral. So mortgage rates going from 3 to 6% over the year basically reduces the number of households that qualify for a $400,000 mortgage, reduces that by more than a third. So not all these households are. Go ahead.
I was going to say, I quote this a lot. Sometimes it's numeric, like 14 million, 18 million. So I've quoted your work just as a sign of respect. I mean, that's important. And I'll talk about that next, but please keep going.
Yeah, so that's roughly a third of households can't qualify for that mortgage anymore. We're seeing mortgage rates actually go above 6 now. So just there was an article in Bloomberg this morning. The NBA's 30-year mortgage rate is at 6.5. Mortgage News Daily mortgage rate hit over 7% yesterday.
7.08.
Yeah, it's absurd, crazy. So if mortgage rates stay at 7% or go above 7% for a long period of time, we can kind of say, okay, what's the effect from going to 3 to 7%? And that additional percentage point again wipes out about 5 more million households from qualifying for that $400,000 mortgage. So it goes from I think roughly 45% at that point of households that would have qualified for a $400,000 mortgage in December no longer qualify for that mortgage. That's a crazy just reset of demand.
No. So something I've been saying, and again, I want your feedback, pushback, tell me I'm wrong, because I want to learn as well. I've actually told people that I think we've started phase 2 of a housing crash, and be very, very clear. I'm not talking price. I'm talking transactions. Phase 1 of the housing crash was demand destruction. And I used your number, right? 3 to 6, 14 million or 18 million. I forget what it was, a lot. And I've said, oh, by the way, it only gets worse from here because we're on an upward trajectory. And I called 7%. I called it in December, not September, but we're here now. So even worse, right? Now I have the numbers, right? So if you said an extra 5 million, now we have 23 million. The demand destruction just destroyed. However, I believe what is very hard for the novice YouTube real estate expert to call is supply destruction. I believe when we went from 3 to 6, we created crazy supply destruction. I believe both you and Black Knight have talked about interest rate lock-in. I call it supply destruction. Basically, I'll be close. 13% of people have something below 3, 50% below 4, whatever it is. Or I guess, no, it was 80% below 4, 50% below 3.5. Now, if you take it to 7, we got to be like at 85 or 90% of people below 6. So I believe what's going to happen between September 15th, I just started calling this, so 2 weeks ago, and March 15th, is record supply destruction. So Jerome Powell may get his demand supply balance he wants, but it's going to be at such a low level. We're going to do sub 4 million transactions on an annualized basis some month before the end of the year. Tell me where I'm wrong.
This is good. I appreciate the willingness to step out and make big calls. The first company I worked at in real estate was just known for making big calls like that. And, occasionally we got them right, occasionally we got them wrong. But I just appreciate the art and the gusto that goes into making a big call.
I may be wrong, but I am certain.
Yeah. Yeah. And I'm curious how you got to that 7% call. And maybe we can bookmark that for later. But I think you're dead on that the rising mortgage rate has distorting effects on not just demand, but yes, on supply. And that to me is troubling. Feels like almost like a Gordian knot that the Fed has. I don't want to attribute it all to them, but the Gordian knot that they find themselves in to manage price stability in the economy, to have only one lever to pull, and that's on demand. So our data, I think, is 73. So 3/4 of mortgage borrowers are locked in under 4. If we go, prevailing mortgage rates today, that's 90 to 99%.
Right? Yeah.
Yeah. So we've seen actually the number of people moving out of their homes every year just fall pretty significantly since
average duration expand. Yeah.
Right. So, if you look at, this is a long-term trend. This is like going back 30, 40 years, but fewer people are moving every year. that happens because one, mortgage rates, people are locked into mortgage rates. They don't want to reset. Also, the population is getting older. Again, alluding to demographics. We can talk about that later. I think you're right on though, that transactions are going to just cinch up, and no seller. I mean, unless you have to sell, unless you need the cash to go buy a house somewhere else because you're relocating for a job or some other reason, who wants to sell when mortgage rates are at 7%?
No. And I think there's a couple of things on that topic, because again, part of this is human nature or consumer psychology, which again, I've studied for 30 plus years. And the reason I'm talking about phase 2 of the housing crash being supply destruction, and I've dated it September 15th to March 15th. Why March 15th? Well, housing has seasonality. I have no idea what's going on in the economy in the next months. There are so many, I mean, it could be World War III and total destruction, and the Fed has a huge pivot to, hey, we put in a bottom and we're marching. I have no idea. It's so confusing. So I put March 15th as a date because I think consumer psychology through the winter is going to be a deviation worse than normal. What happens in the winter? Sellers, pull back, inventory falls. So the big bugaboo in all of this, and why all the housing crash callers in price are wrong, at least in the next 6 months, is supply is going to go to nothing. I think supply is down every month, probably through the end of the year. And I don't think a lot of people see that coming, and it's because of supply destruction.
Mm-hmm. Yeah,
How's that feel?
Yeah, I think you're tracking the same things that we are. I don't see a flood of supply. The last time that happened in 07, 08, there was, adjustable rate mortgages and subprime, and it was just a lot more than what's happening now. So I don't see a flood of supply. There's forced selling, again, very small sector of the housing market today. Mm-hmm. We are picking up on some softness in pricing, and so prices ran up really quickly over basically 24 months, and we're giving up some of that strong, huge increase in pricing. So one of our calls on the pricing is that we don't go back to where it was in 2018 or 2019. We just give back some of that sort of frothiness from the last basically year. Mm-hmm. So I'm interested.
So let's poke at that, because again, people are very interested in price. Just so we're talking about the same metric, I'm assuming you're talking about the median home price for the country. That's the base. That's the number you're talking about. You're not talking about go ahead.
Yeah, I try to separate. So the median price is affected by the mix of homes that are selling. So Correct. It's going to be a little bit noisy through the year. And also depending on where we are in the cycle, we have a metric called the home value index, the Burns Home Value Index, BHVI, which is a proprietary index. It's attempting to measure contracts that are negotiating today versus contracts that were negotiated 30 or 60 days ago. And especially with the Case-Shiller, which, up to 6 months ago, right? So it's almost
a useless report at this point.
Right. So if we look at what's happening in the BHVI, it leads the median, leads the Case-Shiller. And we're seeing, most home markets, the market-wide home value is either flat or down between 0 and 8%. Some of that, again, the larger corrections are concentrated in the markets where prices ran up the fastest.
Yeah, Phoenix, Boise.
Yeah, those places.
Yeah. It's going to be very interesting, and I'm glad you brought up the median home price. So that's all. I don't have a proprietary model. Sorry. Right. I just look at the median home price. I've looked at it for 30 years. So, I have history. I'm kind of tied to it. But you're absolutely right, because when you look at the median home price, we had a surprising decline, or at least severity last time. I think it came in at 386. The month before it was 403. I thought we might get 405. I was wrong, and I own that. Might have been 389, but anyways, I was off by 15 grand or so. But you're right, it's noisy, because again, the median home price last year was when we were doing roughly 7 million homes. Mm-hmm. Now, very soon, I think we're going to do 4 million.
Mhm.
So it's going to have a distortion about what part of the market is moving. Is it the low end
Exactly.
first time home buyer? Is it luxury? I personally think the move up market is dead. And that's why I call transactions, because a move up seller is two transactions:
Yeah.
sell, buy. And if they're not doing anything, not going anywhere, first time home buyers are in trouble because the move up buyer is not selling what they own. And then luxury surprised me again. This was according to Redfin, I believe. It was down 28% in
Mhm.
transactions. So this housing distortion is wild.
Mhm. Yeah, we've done some look at that. Our director of data science and forecasting in our firm, Jacob Belk, has really been a thought leader in our company. And when we're working with on specific sort of client specific forecasts, he's called that the luxury market turns down a little bit later, but the swings are much wider. There's an
Correct.
article in the Wall Street Journal about this last week. Luxury home sales, top tier up something like 80% year over year at some point in 2021, now falling precipitously. And that it's a really interesting, he calls it the chicken and egg problem with inventory. If no one's selling, then no one's buying. And no one's selling and no one's buying. It's just this cascading effect. And so where are we going to get supply if sellers are
Not for
hoarding
builders.
inventory?
They're going backwards.
Right. So we were hoping that the new home market would be sort of the swing supply for housing, and completions. If you look at monthly completions, it's just been flat or barely up over the last few months. So it doesn't seem to be that source of liquidity like we've been hoping.
No, and it's not coming if their earnings reports. I've read most of the public traders or public builders earnings report, and they're like, nope. And oh, by the way, a couple of them, I think it was Hovnanian, said, you know what? We have some for sale communities that we're going to turn into for rent communities.
Yeah.
I'm like, there you go.
Mm-hmm.
Bye supply, not coming.
Right.
So.
That's the other thing that's different this time around is that overall the demand for housing in the economy and in the country is enormous, and it's not,
and where it's needed. That was the big change, right? Zoom towns, more migration. Because again, you decide to move in a second, it takes months, if not quarters, to get, some places years to build stuff. That distortion was, pandemic related, no question.
Right. Yeah, there was even a Fed study, actually. I have it on my desk right now. It just came out this week about saying, what did they say? Some bulk of majority of home price appreciation came because of the pandemic and relocations.
Yep, I read that. I read that as well yesterday. Yeah.
Demand moving around, shifting around the country, and supply just being very slow to respond.
Yeah, you just don't snap your fingers and a house goes up, or a fourplex or an apartment. It's wild to think about. So now let's go from housing to another part of housing, because again, people need to realize the housing market in general, roughly speaking, is 15% of GDP. Only part of that is new transactions.
Mm-hmm.
The other part of it is remodeling, upgrading, right? And it is wild to think about people staying in their homes longer, as we said. A lot of people are going to decide, hey, because I think there's a lot of people that want to buy this is what's happening at kitchen tables around the world or country. Mom and dad are sitting down going, hey, we're making more money now. I want to get a better school. I'm pregnant again. I need another bedroom. They're excited. Then they go look at a house they like. Then they go to a mortgage broker. Mortgage broker pokes in the numbers and says, oh, by the way, yeah, I know the home's only 75,000 more than yours, but the interest rate's now more than 100% higher. That's why 3 to 7.08. Your payment's going to go up. Your payment could double. It could triple.
Yeah.
And then they're going to look at each other going, you know what? Let's go buy some bunk beds. They're going to stay put. They're going to upgrade their home. So tell us what's going on with remodelers.
So remodeling. So we look at remodeling can be split between sort of nice to have projects, this discretionary projects, and the need to have the roof replacements, siding replacements, plumbing repair, etc. Okay. And the repair side of that is the most stable part of the entire economy. So where for sale housing and home building is one of the most volatile, and it leads the business cycle, the repair sector of the housing market is very flat. So it's a kind of a stabilizer. We've been encouraging clients that can to hedge that housing cycle with investments in repair and remodeling. So what's going on in remodeling right now?
Just a quick question on that for the average Joe. Does that mean go buy Home Depot and Lowe's, or what would you tell the average Joe? I mean, is Home Depot, is that where you're going with this for the average person? Go find a publicly traded company that feeds that part of the market?
Thanks for that question. I wouldn't say, I don't know where stock prices are going, so I can't say that. Okay. It's just a way to think about, okay, so if you think about the housing market as a whole, I think one bias that I've had is to look at just home builders or just the existing home market, right? But the home repair market, home improvement market is actually much larger, because if you look at, 6 million transactions a year or 4 million transactions a year that we might hit, that's one, but 1 in 10 or 1 in 5, let's say 1 in 10 households do a improvement projects. Yeah. That's 13 million households. That's 13 million households making that decision.
Great point. So it's 200 or it's 100% bigger, roughly. I did not think about that. That's awesome. Yeah. Cool.
In terms of the number of households that are making that decision, yeah, it's much bigger. Okay. And so what we're seeing is the stable part of that, the repair, maintenance, replacement type projects, those are flat. We don't expect those to change too much. We're actually coming off on the other side, the discretionary, the nice to have projects, the kitchen remodels, the bathroom upgrades, those $50,000 to $100,000 projects, or some of them are whole home. They could be 6 figures, mid to high 6 figures in some places. There was a boom in those projects starting in around mid 2020, and that's carried through. Really, it's the demand from that boom period is carrying remodelers through. So remodeling crews are just as busy as they've ever been.
As of today, or when was the last time you kind of did it's monthly survey?
Quarterly survey. The last time we ran this, the last report was from a survey that went out in July. Okay. We actually just launched our next survey yesterday and this is recording this on the 28th of September. So we're going to have this, published in the next 28 days to our clients. Anyway, so we look at, so that part of the market is interesting because they're really supply constrained. They can't actually increase output too much just because it's so hard to find labor. There's been, supply chain disruptions for materials. So that feature of that part of the housing market is almost a benefit at this point, that they've stretched demand out so long. And the average remodeler in our survey had a backlog of 5 months of projects in July.
Wow.
So they were booked out all the way through this year.
It's going to be interesting to see if that gets cut in half or, moves in a little bit. Again, just somebody who's never done the survey. I've read your reports, but just looking, I'm just trying to put I'm mom and dad at the kitchen table and I want to do a full kitchen remodel, 50 grand. You wanted to do that in July. The economy was feeling good, stocks, Now the world's changing. And again, consumer psychology is very interesting. When they get scared, they retreat. And non-discretionary, i.e. a 50K kitchen remodel would be nice, but they could do it next year also. It'll be interesting to see in this winter if that 5 months of backlog comes in a little bit. Just be curious.
Yeah, there's two things to sort of like the scaffolding on that part of the market that's looking kind of shaky at this point. So one, retirement portfolios. So the 60/40 stock bond portfolio
horrible.
Is rough down. Year. Yeah, it's a rough year. It's down more than it's been since 2008. Just the bond market is down.
Massacre,
right? So people are just seeing their 401ks or their IRAs just shrink. So they're even if they're not funding the projects with that money, they're feeling less wealthy than they were a
Yeah.
year ago.
I mean, that's part of what Powell wants. Let's be very clear. The negative wealth effect. I mean, no question. He only has so many levers. One of them is the negative wealth effect, and he's getting it.
Right, exactly. The other piece of that scaffolding, no pun intended here, is that
A little pun intended.
little pun intended. You're right. I gotta admit that. I love a good pun. The other one is that project financing. So we're looking at it's hard data to get after, but we're looking at the effect of higher mortgage rates on the how that's impacted cash out refinances. So if you talk to some remodelers, 100% of their business comes from cash out refis, or 100% of their business comes from HELOCs.
Well, Well, HELOCs and cash out refis are very different. Cash out refis done. Refis are down 84% or whatever they are. Not happening. HELOCs, maybe.
Right. So there's an uptick in HELOCs just from the we call substitution effect. So it's better to pull out. It's better to pull on your line of credit versus doing a cash out refi. But it's not going up enough to replace cash out refis. So to the extent that the remodeling boom was funded through the buildup in home equity, that is pulling back in a big way right now, even though home equity values are still at record highs. And that's a big long-term driver of remodeling. At the moment, it's hard to extract that equity. So we're seeing again. So the remodelers are busy, and they'll continue being busy probably through the rest of this year and maybe a little bit into next year. But we're looking at that front end. What's the rate of new projects, the new leads that the remodelers are getting, and you're right, it's shrinking right now, and we're going to try and get some stats around that and some clarity around that on this round of the survey.
Yeah. So something I've been saying, and hopefully you can help me with the definition. A lot of people are now talking about a housing recession, which I called early. I actually pivoted about a month ago, and I'm now calling it a housing depression. Now, what do I mean by that? Again, I'm talking about transactions potentially going down 50%, 30 to 50% countrywide. Now we're talking about remodeling business coming in, right? I don't know what the definition of a depression is in housing, but I see a housing depression leading to a U.S. economic recession. 15% of GDP. I mean, if you whack 5% of that, which I think is reasonable, you've got to be in a U.S. recession, right? I mean, housing has led most of the recessions I've ever studied.
Yeah, the thing that I'm in agreement there. So I've my first mentor in the industry is like housing housing leads the business cycle. Housing has turned down before every recession. 2008, 2009, housing was in recession since 2005 or 2006, right? The thing that is, and this might be a segue to the demographics, but the thing that's different now that was different today versus at any point since the 1970s is the underlying demand in the country for more and bigger homes because of where the population is in terms of their age distribution.
Age, family size. Yeah.
Exactly. So I'm at the leading edge of sort of the millennial generation. I was born in the early 80s. And if we're looking at 10 years ago, I was living in New York. I was living in Brooklyn, 1-bedroom apartment. I was like, I'm never going to live in a suburban detached single family home with a wife and a dog and a backyard. That's not for me. 10 years later, that's exactly where I am. And so prime family formation years, prime first-time home buying years, prime household formation years, the leading edge of the millennials are here. And I don't think we've seen anywhere near the full impact of that. Millennials are bigger than the baby boomers, but so one instructive pattern here is what happened in the 1970s is the baby boomers were coming of age into the place where millennials are today, are getting to be. And it was the biggest housing decade ever. More homes built, more homes needed, and was one of the drivers of the wild, inflation that happened that decade.
Yes.
I think we're not going to see quite the run up, but we need a lot more homes. We'll need a lot more homes by the end of the decade than we are building right now and that we are equipped to build.
Yeah, and I think on that, and let's just close this out with the demographics the rest of the way. I not only think it's new homes or new residents, whatever you want to call it, it's the locations. That's what I think is going to blow people up, right? I think for the last, I don't know, call it 10 years, it's been about the coasts. It's about being close to the high income jobs. The pandemic blew that up.
Mm-hmm.
These coastal areas have stupid tax systems. They have, it's just all these other problems. People moved, work from home. Now we have employers moving to the center of the country. I not only think it's a quantities problem, I think it's a quantities times location. So you could have some areas that are oversupplied given historical building.
Mm-hmm.
So you get softer rents and stuff. But then in the middle, it's like, man, we're 5 years behind. It's crazy to think about.
Yeah, I think the 80-20 analysis here would fit, that most of the housing shortages are in isolated in certain areas of the economy. So, if with mortgage rates, so I think about this, we've looked at the sort of the bullwhip effect, which is that's kind of gotten a lot of press over the last year. And where was I going with that? So when I look at the last year, the Fed buying mortgage bonds, suppressing the mortgage rate, increased the demand for housing everywhere because he lowered the cost of housing over the life of a mortgage, right? So those are resetting now. And I think that you're going to see is the shrink of demand is also going to be concentrated in areas where there's weaker demographics. So
exactly.
Call it Northeast, call it
San Francisco.
West Coast. Yeah, right. Yeah, I've lived in San Francisco too. Again, it was a time and place thing. I could do it when in my early mid-20s.
Dude, I gave up my Golden State season tickets, which I'm a diehard fan because I can't stand walking in that. It's just unsafe. It's crazy.
Yeah. So I think, what you're going to see is the shortage and the effects of the shortage of housing, not uniform, spread throughout the country.
Yeah, it'll be very uneven. Yeah, exactly. Let's talk the one thing, because again, one of the things I am battling in my YouTube universe, where I try to help educate, motivate all of this, is there's a lot of channels that are calling for a crash in prices. It's always right around the corner, One of the things that they've used historically, and it might be coming back, is what they call the Silver Tsunami. Right? The baby boomers are all going to die at the same time or go to nursing homes. And suddenly these McMansions, it's and prices have to come down. Demographics doesn't quite work that way. They don't have all the same expiration date. It's just, I don't know. Talk about the Silver Tsunami, and maybe you see it coming and maybe I'm wrong.
I think eventually it'll be a very large impact. If we look at, if we're sitting here in 2040 and we're saying, what's the impact of the Silver Tsunami then over the last 20 years? We'll say it's been huge. The baby boomers are sitting on 72 trillion in wealth. They're sitting on a ton of homes and they can't bring it with them.
No,
right?
They cannot. No, true.
And the tsunami metaphor, I think, is a little bit off because tsunamis come all at once. And
exactly where I'm going. Exactly.
Wipe everything out in their path.
Hence the expiration date. It's longer.
And, there's been some studies that look at this. What's when are baby boomers going to be liquidating inventory? And even if you go to some of the studies that I've seen some of the people, advocating for this position that there's a wave of supply coming because of baby boomers. If you look at the studies that they're quoting, the language in those studies is much less dire than I think a lot of people are seeing or
they're relating. Taking one variable and twisting it the worst way possible? Tell me it's not true, Eric. Come on.
Who would do that, right? So I think there will be an impact. I don't know what that impact will be necessarily and over what time frame, but it looks like
if you look at totality, no question. But where I'm constipated, frankly. It's, guys, you're not looking at the duration. It's, it's going to, and oh, by the way, a baby boomer dies. It doesn't automatically mean they have a spouse.
Yeah.
There might still be there. They have kids. They might. I mean, there's all these other variables. It's just people trying to take a couple of negative stats, spin a scary story because scary story gets clicks.
Yeah.
And, rinse and repeat.
I'd say they're if you want to kind of boil this down, I think they miss a couple of things really, really big. One is that the adult population will continue growing. The adult population is the metric for housing demand. Even as the baby boomers start,
yes,
dying off, the adult population is still going to grow. They're
replaced with the earlier age. Exactly. Yes.
I think they also miss immigration.
That's where I was going next. Immigration.
The U.S. is a scarce good that tons of people around the world want to consume. They want to live here. Okay. It's the freest society. It's the most transparent in the world. Okay. And even if you do have, a higher quantity of deaths, the death rate of the population doesn't necessarily have to go up, or the housing demand doesn't necessarily have to fall. Okay. And immigration did slow down sharply during the pandemic, but it's already rebounding. It's already going back up. So
that's the other thing. I'm so glad we're going to close on this topic. We've had 6 years of below trend immigration. Right or wrong, it's a fact. And I don't think that will be necessarily true over the next 10 years. Even today, the US dollar is strengthening because we are the best economy on the planet. We have, again, we might be the cleanest dirty shirt, but we're still the cleanest dirty shirt. And you're right. We are a place that the best of the best aspire to be. As long as we hold that and there is no switching or replacement, we will have immigration, positive immigration, immigrants who contribute to society. We're not talking about people crossing the border and doing whatever that is. We're talking about engineers, PhDs. The best of the best will come here because they want to be here. They want to make their name. They want to send money home. This is something that for the last 6 years has been below trend. It will come back. It has to come back. And I look forward to that.
Agreed. And I think, yes, to what you said. And also I think to build the homes, to build the country, to build the infrastructure, we need more labor.
Absolutely.
We need to import, if you want to call it that. It feels weird talking about people like that, but
we need more labor. If we don't, we're going to be paying, $100 an hour for people to put up framing or something. I mean, we need help. Yeah.
Right.
Yeah. The other thing that's important that I don't think a lot of people understand about immigrants, and you could tell me if this stat is wrong because it's a little bit old, so it might be wrong. But generally speaking, first generation immigrants have more kids than U.S. households. So again, we have a population, an aging population. You open the doors to qualified immigration. Generally speaking, that first generation has a couple of extra kids, and we can start rebuilding this thing.
Yeah. I think that seems true from everything I've seen.
Yeah. So this has been a lot of conversations. We are mainly a housing channel. When you look at what's going on, I guess I have 2 predictions for housing. You let me know again wrong or where I might be missing. So I talk about year on year in median home price. So not your proprietary thing, because I'm not skilled up on it. I do not see year on year home prices showing a negative number this year. We're only 2 or 3 months away. So again, we had a lot of positives. So it's kind of an easy call, but I get a lot of pushback on that. What do you think about that first?
So I get into the weeds on this stuff. So are you looking at the average of the months year over year?
Yeah. So basically December 22 to December 21 is going to be up single digits, but it will be up, not negative.
That seems like a reasonable
expectation.
Yeah.
Again, I think we're down from the peak 6%, but again, December to December, November to November, nationally speaking, we're up. But people learn your buy box, your market. These are national numbers. Frankly, none of you should care about this number. I just geek out because I've tracked it for 30 years and I'm not going to stop. Now for the money. Median home price, December of 2023. this is way out over our skis. Again, wild ass guess. Nobody has a crystal ball. Who knows if we're in World War III? I mean, it's so many weird things going on. What I'm calling for 2023 is flat. Frankly, and by flat, plus or minus 2%. Median, national. And frankly, I'm calling flat for 5 years. One of the things that I agree with everyone is we have a affordability problem. Rates went nuts, which is only making it worse. It was bad at 6, it's worse at 7. I think what's working behind the scenes is we're going to have wage inflation a la the 1970s, which will make housing more affordable each year. So we're going to be flat for 5 years, nominal, real, we can go backwards, nominal. And then we'll see where we go. That's kind of my impression on the future. Tell me where I'm wrong.
I see a higher likelihood, I think, than you, that the median home price December 23 over December 22 is down. I think two things. One, in a recession, if we go into recession, which I think the Fed will,
I agree with you.
Will cause, right? They have a perfect batting average on when they want to cause a recession.
When they want one, they get one. Yeah, exactly.
Yeah. So I think that changes the buyer psychology on some level, but also I think the median price is going to be affected by the mix of homes selling.
Yeah.
Right. So
could be right.
So if you just look at what the median household can afford,
it's horrible.
7% mortgage rates versus what they can afford at 3 or 4. They're going to have to trade down if they want to buy a house.
rent longer.
Or rent longer, right? But I think yes, and I think the things that in a stable economy, higher rates keep people in rentals, boosting rental rates, right? And I think the variable there that's changing is the economy is now softening.
Correct.
I think we do go into recession next year at some point.
I agree.
And that overall reduces demand for housing, right?
I agree. People roommate up, they stay home more. Yeah, they just
delay purchases, delay household formations. At the same time, a huge chunk of multifamily supply will be coming online over the next year.
Yeah, it's gonna be wild to watch. Eric, do me a favor, tell people where they can follow you, and feel free to give any shout outs or kind of closing thoughts on what you see coming. This has been a lot of fun.
So I want to just mention that everything I've said today, I'm sort of standing on the shoulder of our team of analysts, associates, forecasters. We have a hugely qualified team, and I'm amazed at how much data and analysis they churn out weekly. So it's just an incredible organization that I find myself a part of. That's one thing. The second thing is that follow me on Twitter if you want. My username is just my first and last name, Eric Finnegan, or on LinkedIn. I post some different things on different, each platform. And I work at John Burns Real Estate Consulting. You can find us at realestateconsulting.com.
Yeah, John Burns Real Estate Consulting is probably it's the most quoted source of real estate data in my daily financial news, which is over 1,000 days in a row. I appreciate you for being here, Rick for being here, the entire team at John Burns. You guys just keep rocking, keep killing it, helping people. You guys are amazing. Eric, thank you so much.
Great to talk with you, Michael.
You got
Thanks
it.
so much.